whether the case for China still stacks up, and we think it still does. In the long run, we think it's actually very supportive for the companies that we own and for their share prices. We have started to see very good numbers for a lot of our internet platform holding. I'd say more broadly, sentiment towards the asset class appears very negative, and in our view, consensus or the market view is too pessimistic. I do think that once conditions improve, some of that sentiment may turn. We do think that there are potentially other pools of capital that could replace, particularly US money.
How is big money actually thinking about China, Chinese equities, Chinese stocks, whether they are listed domestically in Hong Kong or overseas in the US exchanges? This is an important question, and I found some very nice insight here that I'm going to share with you guys, and that's actually coming from one of the biggest shareholders of NIO Stock. So we are going to find out not how they think about the individual stocks, but rather like what is their general view on holding, buying or selling some of these names based on some of the biggest questions out there about the Chinese economy, the Taiwan question, the question regarding the tech crackdown and stuff like that. So we'll be hearing from a fund manager of Baillie Gifford directly. Once again, one of the biggest shareholders of NIO. And so this should be insightful if you're invested in the company, because of course, some of the largest institutional players, they have a very, very long time period and time horizon in which they're investing. And so we're going to watch this video together, and I will give you also a little bit of my added commentary. And so I hope you find that insightful. Please subscribe to this channel and hit a like. That will help to get this in front of more viewers, and this makes also sure that you won't miss out on any other videos like that in the future. So let's jump into it.
We've experienced cycles like this in the past, and I think the key to getting through them is really sticking to your philosophy and your process. So for the China Growth Trust, we're sticking to our growth bias, and we're sticking to our fundamentals-led research. We've gone back to basics on most of our holdings and gained comfort from the fact that their operational performance is coming through as expected. And in addition, we've spent a lot of time working out why returns have been volatile or poor more broadly. And then, based on that understanding, whether the case for China still stacks up, and we think it still does.
Starting with the good news here, Baillie Gifford still seems to be positive on China overall.
If I could expand on that a bit, looking back over the last 3 years, China's faced an unprecedented series of challenges. So we had COVID, a regulatory clampdown, and a worsening geopolitical environment. These challenges have hurt private sector and consumer confidence. They've negatively impacted sentiment towards the asset class, and they've resulted in very weak returns. But if we look forward instead of backward, we think prospects for China look much brighter. So, at the broad level, whilst growth in the property sector is likely to remain lackluster, we think the risk of financial stability is low. We think a consumption-led recovery is gradually taking shape, and that the government support for the private sector is likely to accelerate this somewhat. And then with geopolitical concerns, whilst they're likely to remain a headwind to sentiment, we think there are signs that both sides want to stabilize the relationship.
So this is actually a good point, because regarding the need for stabilization of the relationship, we see a couple of hints towards that just in the last couple of days, where we see that there are talks happening between the US and China. And also, again, it seems there is a preparation for a Xi and Biden meeting later on. So that's going on in the background, and I think actually there is some reason to believe that actually such relations need to get better. And I think there's actually even a big reason for the US to rather start a charm offensive regarding China, which is the macro environment in which we're now seeing that the inflation is coming down as we have been anticipating and hoping for, and at the same time there is a lack of buyers of the US Treasury bills, and that keeps on spiking the interest rates, right? And at some point in time, with those high interest rates, the debt that the United States government also needs to serve will become quite expensive. And so if there are no buyers for the treasury bills and the rates keep on spiking, that's an unsustainable situation for the United States government. And so I think they want better relations with China so that they start buying T-bills again instead of selling them, because otherwise the only option out would be that the Fed is going out and buying those bonds, and that would result in a devaluation of the US dollar.
And then, I mean, more importantly for us, as sort of bottom-up stock pickers, the attractions that China offers to us remain very much intact. So whilst GDP growth overall may be slowing, we continue to find, pockets, very large pockets actually, of structural opportunities. So, areas like healthcare, renewable energy, semiconductors, automation, domestic brands. And then just on the trust portfolio itself, the portfolio itself remains overwhelmingly sort of exposed to these longer term disruptive and secular growth themes. And I think that's reflected in, for example, forecast earnings growth for our portfolio of around 15% per annum for the next 3 years versus the benchmark only 9%. And encouragingly, the operational results of many of our holdings are good or sort of on an improving trend. So we think that with valuations attractive in both an absolute and a relative sense, that it's only a matter of time before the strong operational performance is rewarded with good share price and good returns.
So the bottom line here must be that Baillie Gifford is in for the long run. You may know the prospectus for NIO and what they think this company could do in a decade, and clearly they have a very long time frame. And still today, the fund manager here believes that the prices will eventually catch up to the performance of the underlying companies.
We've had a decade almost of unrestrained innovation or growth in key new areas in China. And I think it was actually time for, the regulator to provide a bit of a check. And if I can just give you a couple of examples here, transactions via WeChat Pay. So WeChat Pay is Tencent's payment platform. They increased from basically nothing to around 1 billion a day over the last 10 years. Now, if we put that in context, Apple Pay only processes around 1 billion transactions a month. Or in e-commerce, for example. So Amazon is 13% of global e-commerce sales. Alibaba now accounts for 29%. So, e-commerce penetration in China now dwarfs that of the US. And let's put this in context. So, with the regulatory backdrop, in the US, we've had 150 years of antitrust law. Chinese antitrust law was only written in 2017, and it only started to be taken seriously in the last couple of years. So China did have a lot of kind of catching up to do, not in terms of innovation. It was innovating and growing much faster, but in terms of regulation. And I think also if you look at the content of regulation, actually in the main, it's been remarkably sensible. And the motivation behind it has been to try and foster, I think, sustainable growth industries for the future. And that's impacted in some cases short-term earnings growth. But in the long run, we think it's actually very supportive for the companies that we own and for their share prices.
So if you're following this channel, this take about the China tech crackdown should sound very familiar, because this is actually entirely in line with my thinking. I've always went out and kind of almost defended some of the anti-monopoly regulations for Alibaba, Tencent, and so on, because I always said, there has been a period of laissez-faire capitalism in China, which went totally unregulated, and I think it will be very sustainable and better in the long run, and actually foster new innovation with the sorts of regulations that have been introduced. Maybe not, of course, in some sectors, like where it was very tough, like the educational sectors. Those companies have been destroyed in a way, and the stock price with that. However, I think it's a large overreaction regarding the headlines in the media, and second of all, the stock prices when it comes to the fundamentals of these companies and what these rules actually really brought about.
the government had a very prudent approach to COVID stimulus. So I think COVID stimulus was around 10% of Chinese GDP versus around 70% in most developed market countries. And they've also been reasonably conservative when it comes to the property market in terms of trying to cool that over the last decade. So I think actually the government has a number of levers that it can pull. China is one of the very few countries in the world that has and can continue to lower interest rates in response to economic weakness. It can also, and it has begun to relax those restrictions that it put on property in the early 2010s. Actually, in July, the central government gave local and city governments the go-ahead to relax restrictions on home purchases. And in August, we saw Guangzhou, a major tier 1 city, become the first to act. We expect others to follow suit. And for this sort of gradual easing approach from the government to bear fruit. I think it's also important to remember that the Chinese consumer and the private sector in aggregate remain actually in very good financial health. So the Chinese consumer saved up an estimated 7 trillion of excess savings during COVID. And the private sector, as I said, in aggregate remains in very good health, good balance sheets. And it's actually the private sector that accounts for the majority of GDP growth and the majority of job creation. Both the private sector and the consumer has been hurt, I think, by COVID lockdowns and by the regulatory clampdown. But I think it's only a matter of time before confidence improves and therefore spending and activity improves somewhat.
Wouldn't it be lovely if we sometimes get such rational takes in the likes of Bloomberg, Wall Street Journal, and the Financial Times and so on? You've possibly seen all of the headlines about the weak Chinese consumer, Evergrande, the debt, and so on. But this take is somewhat more realistic, I would say. It's admitting that there are some structural problems, however, that most of the fear out there is kind of, just too much. It will not be the end of China or the collapse of China. And that's why Baillie Gifford is looking forward to this opportunity, however, with some remarks here.
And then just a final note on, what macro sort of means for us. We'd actually note that, macroeconomic forecasts tell us not a huge amount about long-term returns for active stock investing in China. So, for example, China's nominal GDP in US dollar terms has grown tenfold over the past 20 years. So that's around 12% per annum. Yet MSCI China has only returned around 6% per annum. So these unimpressive index returns actually mask fantastic performance at the individual stock level. So, for example, over 5 years to the end of 2022, I think Chinese companies accounted for around almost 25% of global companies who have returned 15% per annum in share price terms. So it's not to deny that China has, structural issues, but it's rather to show that there's a persistent gap, I think, between this sort of perceived kind of macro doom and the sort of hidden kind of micro opportunities that we're finding. China imports around 70% of its oil and around 45% of its gas. And actually geopolitical sort of risks have made energy an even more important item sort of on the national security agenda for China. And this is translated into massive incentives to invest heavily in renewables. And we've seen that over the last decade. And again, it's really private companies here that have led the charge. So China now has around, I think it has 6 of the top 10 global EV battery manufacturers in the world. It makes over 70% of the world's solar cells, and it contributes roughly 2/3 of new global wind power infrastructure. It also accounts for almost 50% of total EVs in the world. And many of the companies, playing to this theme are found in our investment universe. We have started to see very good numbers for a lot of our internet platform holdings, which I think suggests that that consumption is gradually sort of recovering quite well. So, Alibaba, the world's leading e-commerce platform, or Tencent, China's most popular social networking app, they both saw a return to double-digit top-line growth in their most recent quarterly results. More importantly, both companies benefit from very large structural growth opportunities. And both, again, remain very attractively valued. So, for example, Alibaba's e-commerce business, if you strip out cash and investments, it's trading on a single-digit price earnings multiple. I'd say more broadly, sentiment towards the asset class appears very negative. And in our view, consensus or the market view is too pessimistic. We think a lot of the sort of market's concerns are already priced in. And as I said, we are starting to see the beginnings, we think, of an improvement in the domestic economy, particularly where consumption is concerned. And then, for us as active investors, as I said, earlier, we do still think China continues to offer these big picture sort of structural opportunities.
So I guess one of these companies, of course, is NIO, which is not only in the area of EVs, but also with power swap stations, part of balancing the grid in the future and playing a role in the national grid system in China, maybe globally. And also with all of their ventures that they're doing active in very different verticals there. And so, of course, also other companies in Baillie Gifford's portfolio. Now the latest comer here is BYD, interestingly, and also others. But generally, this is an opportunity in their point of view still as of today.
We have had a really awful 3 years. And sentiment does tend to be pro momentum, so it's no surprise that I think these calls that China is uninvestable have sort of gone up after the experience we've just had. And I do think that once conditions improve, some of that sentiment may turn. And then finally, just in the longer run, we do think that there are potentially other pools of capital that could replace, particularly US money in the market and potentially provide support for equity prices in China if you were to see a real sort of marked continuation of decoupling. So, pools of capital, for example, in South America, Asia, or the Middle East.
This, in my point of view, was a very big statement. Basically, she's saying here, look, if the US investors are going to retreat from China because there is ideology, there is politics and a decoupling, then others will go in. And it might be capital from other parts of the world that will be replacing the US investors, no matter where the shares are listed. But there will be somebody who's filling that gap. And remember, for the price, it doesn't need a particular super high demand or volume, but it just needs to be an agreement on price. It's essentially a market in the end, right? So really interesting to see Baillie Gifford thinks that even in the case of US investors not playing a larger role with Chinese equities anymore, prices could go up.
I was in China in May of this year. It was a fantastic trip. It was a joint trip with actually both of the managers from Scottish Mortgage.
Then what I really like about Baillie Gifford, in contrast to, for example, the ARK Invests of this world, is that they're not only talking about stuff and going on the TV channels, but they go onto the ground, make their boots dirty, and they speak with those companies' owners. They are in China and they have a research team on the ground, and not only analysts that are just based in the US and have no idea of China, are not speaking the language, and so on.
So it was that combination was fantastic because obviously those guys invest globally. So hearing their sort of point of view on some of their global perspectives on some of these Chinese companies was really very interesting. We spent a week in China, traveling around, seeing most of our large internet platform holdings, including ByteDance, seeing some new ideas in the semiconductor space, and then seeing a number of competitors to our existing holdings. What struck us, for me, prior to going in May, I was last there in January 2020. Actually, really what struck me was from our platform companies in particular, there was a greater degree of confidence in both the domestic economy, but also the management of the domestic economy. So a lot of positive comments from a number of our holdings on Li Qiang, the new premier.
By the way, do you remember when Chinese equities sold off between 10 to 20% on just one day? I think that was when the third term of Xi started and a new government was announced. And I said, well, look, some of these people are not bad. And I mentioned exactly the same guy, Li Qiang, who's responsible for bringing Tesla into the country, who's extremely pro-business. And by the way, there's just one news out that China has now loosened some of the grip on a new regulation which has to do with international data transfer, which is applicable to foreign companies operating in China. And that's a clear pro-business move, and also very much in contrast to what everybody is saying about, China is not opening up to the world anymore and stuff like that. And coming back to regulation again, what she also mentioned about the fact that China is just starting to get all of these laws and regulations into place, and therefore also, of course, somehow struggling right now with the implementation and the first drafts of these rules.
In contrast to a lot of the reporting that you read in the West, there was still, I think, a good degree of animal spirits and a good degree of, I'd say, optimism. If you'd asked me that question sort of a year ago, I think we were just in a less good place. In May, it was striking that there was more positivity, basically. I think it's fair to say that the weakness in property is having an impact on overall growth within the economy. But I think some of the headlines that we read about, the risk of financial instability is. We still believe that the risk of financial instability from the real estate sector is low. A couple of points to make here. So property sales are down almost 50% from their 2021 peak. So activity is depressed, but prices have barely budged. And I think this is a key point. China has never experienced the sort of asset price bubble that has precipitated almost every property market crash in developed markets. Property prices have grown at around 7% over the last decade, but income growth has surpassed that. And property actually on average remains affordable. And whilst, developers such as Country Garden, which has hit the headlines, have become over-indebted, the Chinese consumer actually remains in pretty good health, as I've, already talked about. And as we talked about in the conversation, the government can't, offer a very large stimulus package, and I don't think it wants to, but it can gradually ease, and that's what we're seeing. And I think what we will see is just a stabilization in property, partly due to the government's gradual easing approach, partly due to activity improving as consumer confidence improves and as private sector confidence improves, and that China will sort of kind of gradually grow out of this. So we aren't too worried about it at this point in time. We're in a place now where I think a lot of those concerns around sort of geopolitics more broadly, or Taiwan, are already in prices. So I think, again, remember where we are, remember our starting point now. And yeah, we're bottom-up stock pickers. We remain very humble in terms of, our ability to predict sort of geopolitical events, but our 2 cents on this would be that on Taiwan, it's a very sort of low probability, we think, but high impact event, and it's low probability because of a number of reasons. The incredibly high stakes involved, the fact that a defeat here would, I think, seriously threaten the legitimacy of the government, the fact that it would be a very difficult endeavor in a military sense, which again greatly increases the chances of failure. And then because, the government, contrary to sort of Western reporting, the government has been, I think, more focused on their domestic commitments than they have been on sort of foreign policy. These promises to increase living standards, deliver a prosperous society by 2035, all of these domestic commitments would be unachievable, in the event of a worst case scenario. So
whether it's about the economy, about the tech crackdown, about Evergrande, the debt situation, to the Taiwan question, I think these are very moderate, realistic views here by the growth manager of Baillie Gifford, and largely in line with what I've also been preaching here on the channel. That is based on my personal experience, how I read the news, rather the first-hand sources instead of the news, because interestingly, she also kind of hinted a little bit how she seems to be annoyed by the media headlines, right? So let's see where all of this will be going. I thought this is worthwhile sharing, that there are investment managers out there who have this long-term view and kind of a more realistic stance on the actual situation. And now let's see how this all pans out. Let me know in the comments, what are your takes, where you disagree, where you agree, and then thanks for watching, hit the like, and see you in my next videos.